Meantime, bank stocks are in rally mode. Bit of a different story, though. The biggest names in the sector nicely outperforming the broader market since the start of the year. It's a move that Wells Fargo analyst Mike Mayo forecasts right here on Squawk Box.
Banks are on the road again to the pre-pandemic returns and valuations that they had a couple years ago.
Mike Mayo is back with us to talk about the banking sector and what happens next. But Mike, these stocks are up 20%. I can't get excited about this when I've got GameStop at 150%. This is it's disappointing. It's disappointing, Mike.
Well, look, we expect bank stocks to reach all-time highs in the near future. We have more confidence in our forecasts, given the resiliency banks have shown through the recession, given their road to record efficiency in a few years, and more evidence that this is not your parents' banking industry. It's night and day versus the financial crisis. Instead of credit costs going out of control, banks are releasing reserves for credit losses. Instead of banks issuing equity, banks are repurchasing stock. Instead of big charges and mishaps and banks causing the problems, banks are part of the solution. And nowhere do you see this more than Bank of America, which I know, Andrew, you wrote about during the period of the financial crisis. And, 10,000 years ago was the agricultural revolution. Well, Bank of America has had its own version of the agricultural revolution as it's gone from hunter and gatherers to farmers. Instead of, hunt that mortgage, gather that trade, seize that acquisition, now they're like farmers, cultivating and growing relationships, sustainable earnings, year in and year out. And this is really just banking. This is just banking 101, by the way, this call, still being bullish on the banks.
Okay, but let's break it down here because we got a couple stocks on the screen here. Where do you stand on B of A versus Citigroup versus a Goldman Sachs versus a JP Morgan?
Well, as we said on your show at the start of the year, we like all four of those. Almost all the large bank stocks have outperformed the market since the start of the year. We think that remains the case, especially for these four banks. But Bank of America is our number one pick. And if you look at their revenues, they are the biggest beneficiary of the steeper yield curve. It looks getting a little steeper this morning, in fact, among the largest banks. And when it comes to costs, credit costs, they've de-risked for the past decade. Andrew, you remember level 3 assets. That's not a term we talk about. They were 10 times higher at Bank of America during the financial crisis. So they've de-risked. And then expenses, they're a leader in technology and digital banking and fintech. And they've had over 4,000 patents for their technology. And they're not getting credit for that. Maybe they need to move their headquarters from Charlotte to Silicon Valley to get credit.
Well, that's what I was going to ask you, though. We're talking about traditional banks here. If a dollar's fungible, would you rather have a dollar in Bank of America or a dollar in one of the big fintech companies, whether it be PayPal on one side or maybe even one of these companies that have recently come public, whether it's in a firm or a SoFi coming public through the SPAC? How do you think about that today?
Well, look, the stock market's taken off and it's left the bank stocks behind. The catch-up trade for bank stocks still has a way to go. Versus a year ago, today, bank stocks have still underperformed by 700 basis points. Bank of America in particular, we expect their earnings to grow twice as fast as the S&P over the next 3 years, yet they still trade at a discount relative to the stock market as a whole. That doesn't add up, except to say that's an opportunity.
Shepard Smith here. Thanks for watching CNBC on YouTube.